Hello, chart watchers. Happy Valentine's Day and welcome to this Wednesday, February 14th Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Pretty interesting morning this morning. We had some not so great economic news that I will get into here in just a moment. But as you can see on the chart, actually I'm waiting, I think it's up. But we do have the Dow Jones Industrial Average right now turning into negative territory. We had a pretty rough start to the day, especially pre-market, after we had some rough retail sales numbers and inflation numbers come in. But we did move back into positive territory, and but now starting to pull back. You can see selling's kicking in a little bit. The Dow is down 11 points. The S&P 500 continues to trade up a little bit today, up 9 points. NASDAQ having a very solid day. Pulling back a little bit off the highs, but still up 60 today. The Russell 2000 also performing very well on a relative basis. 10-year Treasury yield continuing to move higher, and especially with those inflationary fears out there, we saw the 10-year Treasury yield hit 2.90%. Volatility is on the decline, down 19% this morning. All the way down to 20, was briefly moving below that 20 level earlier today. So definitely want to keep an eye on that later today. Some of the key areas of the market, I find it encouraging that we see the four aggressive sectors: technology, industrials, consumer discretionary, and financials all doing well. Within the consumer discretionary space, media agencies having a really stellar day today, up 20 points, as you can see. The reason, IPG, Interpublic Group, reported very strong earnings. You can see a really big move on IPG this morning. Facebook leading a strong internet space. Railroads performing well. Banks doing well. And, of course, J.P. Morgan, one of the big banks, having a very nice day today. And with that, I will turn it over to my co-host, Erin. How are you doing this morning, Erin? And happy Valentine's Day.
Oh, well, thank you very much. Happy Valentine's Day to you. I got a nice little card on my desk this morning from my newlywed husband. So we'll see if it continues on as we go, but it was very sweet. So Valentine's Day is fun.
Yeah, and here on this very special Valentine's Day, we have a very special guest. He's editor and publisher of The Market Strategist, Charles Kirkpatrick. How are you doing today, Charles?
Well, just great. Thank you, Tom.
That is what's awesome to have you on here. Now, we always like to find out where everybody's kind of coming from, because this whole technology thing where we're able to all connect at the same time is pretty cool. But where are you stationed at today?
Well, I'm at my home office in Kittery, Maine, sitting here looking out over the ocean.
Oh, wow. Up in Maine. Okay, I can't complain about cold weather anymore.
No.
I got the wrong guest to whine. I'm not allowed to whine anymore. But anyway, yeah, we're going to be coming back with you here probably in about 10, 15 minutes, Charles. We can't wait to hear your presentation. I know our audience can't wait to as well. But Erin, I'm going to go ahead and just turn it back over to you, and we'll go through announcements and the agenda, and we'll get this party started.
Absolutely. And with that, so what's our weekly schedule coming up for the rest of the week? Tomorrow, we have Julius de Kempenaar, the RRG creator, and he'll be talking RRG with us. And then Friday, I'm going to do a workshop on bull and bear market rules. I think it's appropriate time to start thinking about both and how to trade based on those. So today's agenda, however, we're going to start off with Charles Kirkpatrick. Very excited to hear his presentation. And 10 and 10 to 1. I understand he may stick around for that. Our first symbol is going to be the Ultimate Software Group, ULTI. So if you want to go take a peek at that chart. And then we're going to finish off the program with Under the Radar, stocks that we're seeing that might be floating under the radar. And with that, Tom, what is that technical news going on? What is the bad news you were telling us about?
Well, it was crazy this morning. I tell you, with the volatility index as high as it's been, and with the news coming out, I really thought this could be a rough day. But, you know, I kind of take this as a good sign when you've got volatility as high as it is and you've got bad news coming out and the market seems to handle it in stride. Maybe points toward the worst being behind us, but we've got a lot of technical levels to get through, and we're going to talk about some of those in just a minute. But before I get into any of that, you can see the 10-year Treasury yield on your screen here. The TNX up to almost 2.90%, setting a new high. Of course, I'm going to give you some economic news that is driving this, at least partially. we had the January CPI come out this morning, and it showed plus 0.5%. The market was only expecting 0.3% rise. So inflation certainly picking up. And if we look at the core CPI, the market was looking for plus 0.2%, came in at plus 0.3%. So we got hotter numbers coming through on inflation, and higher inflation also tends to send interest rates moving higher in addition to strong economic news. And so as a result, we're seeing about what I would have expected, a move up in the 10-year Treasury yield today. January retail sales came in weaker than expected, however, down 0.3%. The market was expecting a rise of 0.3%. And if we strip out autos, the January retail sales came in minus 0.2%. And the market was looking for plus 0.3%. So not great news in retail for sure. I think I read an article that this was the weakest retail report in 11 months. And it certainly appears so on the surface. At 10 a.m., December business inventories came out. They rose 0.4%. The market was expecting 0.3%. So we take all of that together, and the bond market sells off, and the 10-year Treasury yield continues to move higher. This time, however, as the bond market is selling off, some of that money is actually rotating into equities, and that is a good thing. So let's take a look at a couple of areas of the market. First, I wanted to bring up retail. I'm going to bring up the XRT, because look at this move today. We had a gap down, not very good retail news, and now look at this move back to the upside. Clear resistance overhead on the XRT is up at about that $46 level. That's where we had gapped up a few days ago, maybe a week ago, before we had this long red filled candle, meaning that there was a lot of selling from open to close. And that has been the reaction high off of the move down from the latter part of January. So I think $46 is pretty big. And then throw in the fact that you've got the 50-day and the 20-day moving average also just beneath that 46 level, and that's going to be a level to watch on the XRT. But again, I think the reaction today in retail is very bullish given the bearish news that came out before the bell. So that's an area I'm watching pretty closely. The overall market, really when we talk about the economic news that was out this morning, let's pull up let's see here, SPX. Let's take a look at the S&P 500. Now, I think there's a couple things we want to watch here. First of all, we're trying to move higher for the fourth consecutive session off of all the selling that we've seen recently, and we're seeing that volatility index come down. But there are a couple things that I think we need to watch here, and I'm going to annotate for those of you who are Fibonacci folks. Let's just start right up here from the top where we were, and let's just drag this down. I didn't quite hit it, but I'll fix it here. So roughly from the top, you can see we pulled back, and on this rebound, what you want to look for on Fibonacci are a few different key areas. One being the 38.2% retracement off of the downtrend. We are now moving through that first level. We were there at the close yesterday, so I thought this would be an interesting area to watch. But really, when you get up to 50% and 61.8%, that's kind of the key zone on Fibonacci. And notice both of the moving averages also come in at that level. Also, the reaction high off of the huge first round of selling comes into that zone as well. So I think the 2702 to 2743 area on the S&P 500 as we rally, it's going to become a very difficult area, I think, to get through, and very meaningful if we can get through it. So that's going to be something to watch very closely, I think, as the days continue to unfold here. Let's take a look at the NASDAQ, and I'm going to bring the NASDAQ up on an hourly chart. But first, let's pull up the NASDAQ. You can see on the daily chart also trying to get back up to the moving averages. We'll see whether or not we can get through. One bothersome thing as we've been rising, check out the volume. The volume has been continually declining. So if we're going to get through some key resistance levels, we're going to need probably a little bit more volume than what we've been seeing as the volume declines. So that's something to keep in mind. But let's take a look at the hourly chart, because I think the one signal, notice that as we broke above the 20-hour EMA, each time we've pulled back, we've been holding that. I think if that gives way, if we get back up to 7150, I think that's clearly going to be an area to watch. Perhaps maybe we'll put in an inverse head and shoulder pattern. We could have a left shoulder, neckline, head. This could go up to 7150 to 7175 to establish the right side of the neckline, and then maybe one more move to the downside could establish an inverse right shoulder. Something to watch, just a pattern that could evolve. But again, with the volatility index now moving back down into the 1920 range, I think it's going to be really important as we get up to these key resistance levels in terms of price, whether or not VIX holds that 16, 17 support level that I like to watch, because in the last two bear markets, we did not ever go back below 16 on the VIX. You need that elevated fear level in order to continue in a bear market environment. A bear market requires fear. So VIX is going to be something really interesting to watch. But as I pointed out, with Fibonacci, with these moving averages and setting up possible patterns, I think another 1-2% on these indices back to the upside, and we're going to start hitting some serious overhead resistance worth watching. Finally, I'm going to pull up the Russell 2000. I want to pull this one up on a weekly basis. Talked a little bit about the Russell 2000 yesterday. I wrote a lot about it in my blog this morning, which many of you hopefully have checked out or hopefully will check out. But you can see on the price, the 1440 area really stalled the Russell 2000 last summer. We pulled back. We hit price support down around 1350, and then we went through the 1440, 1450 area. And notice the low back in November, and again, just this past week, we went down to 1440, 1450, but we held and started to rally back up again. Now, in my blog, and I'm just going to pull it up very quickly, but if you go into the Trading Places blog and pull up today's article, I made a pretty strong case for the Russell 2000. I talked about this yesterday, so I won't spend a lot of time. But if you weren't here yesterday, take a look at the current outlook section of today's blog. Huge move up in the difference between the U.S. Treasury 10-year Treasury yield and the German 10-year Treasury yield. That has been steadily climbing. And as John Murphy's pointed out, and I subscribe to this theory, I think that when you're looking at the yields in the U.S., you really need to compare them to what's going on around the globe. And when the yields are rising faster here in the U.S., it tends to strengthen our dollar. But notice the dollar's been coming back down, and the dollar actually has hit a major support level at about 89. So if the dollar rebounds from here, and I'm going to go back up here real quick, but the last couple of times we've seen this negative correlation between what's going on in the Treasury yields here in the U.S. versus Germany and what's going on with the dollar, that has generally resulted in a very quick move up in the dollar, and as a result, a very quick move up in the Russell 2000 relative to the S&P 500. Remember, if we get a big move up in the dollar, the S&P 500 companies, these are multinational companies, do a lot of business overseas, and when they have to translate those gains, those profits back into the U.S. with a more expensive currency, then they lose a lot of those profits. And as a result, when you start seeing the dollar move up, the domestic companies here in the U.S., many of the smaller companies in the Russell 2000 tend to perform much better. So what we've seen is when we've had these, the red shaded areas are the ones to really kind of keep an eye on. That's where we've had movement up in U.S. Treasury yields versus Germany, but the dollar went down. And normally what happens is right after that, the dollar plays catch up. And we saw it back in 2010, 2011, and then again in 2014. Yields continued rising, but you can see the dollar went down, then the dollar played catch up really quickly. And during both those moves, that's where you saw tremendous outperformance by the Russell 2000. And then finally, where we sit right now, look at the yield again, rising faster here in the U.S. The dollar's been weakening, but we know the dollar is at key price support and trend line support. And also, the Russell 2000 is at key relative support versus the S&P 500. So I made an argument that I think we could bounce on the dollar. And if the dollar bounces and we stay in this bull market, I might look for another major push higher in the Russell 2000. We're seeing a little bit of that today with the Russell outperforming the S&P, but this could go on for a while. These last two periods lasted anywhere from about maybe about 6-7 months. And so the article that I wrote, I just suggested that maybe the small caps, the Russell 2000, might be the best investment over the next 6 to 12 months. We shall see. But with that, I am going to turn it over to Erin. I know, Erin, you have several upgrades and downgrades for us. What do you have?
All right, let's get to it. Oh, okay, see if my sharing screen's going to work today. Perfectly. All right, so right now I'm just giving you the summary. We did have 2 downgrades today that we're going to cover and 4 upgrades. You can see which ones those are right now. So let's go through and look at what I've been looking at as far as these charts go. Make this bigger. Perfect. All right, so the first one, this is one of the downgrades, Dynavax Technologies. And I was just noting the support levels here. That's right after that gap. You know, we haven't closed that yet. I don't think we will, but you could make a case for a head and shoulders sort of forming here. But I'm more concerned about the declining tops trend line and this area to watch price move up to. So I would say that there, you know, we've got the downgrade, but there could be a little bit of possibility in picking this up on the downgrade. I'm noticing my PMO is rising. We're on a buy signal that came out of oversold territory. Scooter's at a pretty decent rate here, so I thought that one looked interesting, but I would be watching that declining tops trend line. I want to know that it could get back up above it, basically since we just got a downgrade, so I would be just a little bit nervous about it, but I like the setup. And we see Lloyd's also had the downgrade today. It's sitting right on this pretty strong support level, though. I suspect it's going to hold. The PMO, yes, it's in decline, not looking so great, but I can see a little bit of deceleration starting here. Pick up on that OBV, which I like. The Scooter is still at a decent rate at this point. So I would be looking for this bounce to possibly continue here, but I would watch that support area at about $3.70 on Lloyd's. Global Blood Therapeutics. I didn't actually annotate this one. You know, I didn't see anything overly exciting. First of all, I have a PMO sell signal, and the PMO is still heading lower. OBV looks okay. It is sort of trending upwards, which is nice, and the Scooter is pretty high. But I just didn't see anything overly interesting here. We've already got a 2% move on this upgrade. Not so sure there's that much potential there. Patterson UTI Energy, another upgrade today, and another stock that's found some support. I'd be a bit concerned about the possibility of a reverse flag here, but it is holding the support level. There is lower support available, though, if we do see it drop below that $17 mark. Don't like that PMO, looking pretty ugly, but it is starting to get into oversold territory. So, you know, it might be worth a watch here, see if that $17 level will hold. And you can see the Scooter starting to scoot up, and that's always good news as well. So that one didn't look too bad. Target, look at very quickly. Nice breakout from that declining tops trend line, heading up to overhead resistance here. Look at the PMO starting to turn up. I always like to see that. Scooter looks healthy. OBV bottoms are starting to rise with price as a pretty good confirmation. And look, I got a 5-20-day EMA positive crossover, and that gives me a short-term trend model buy signal in our decision point trend models.
Erin, Target also is part of that broadline retail group that's just absolutely been on fire as well.
Yeah, absolutely. So this is, I like that breakout, and we still haven't hit the overhead resistance. And I think if we look at a weekly chart, this is pretty important overhead resistance, so we do need to get over that. But the PMO is rising strongly, albeit it's a bit overbought. But I think this one still looks good, and like you said, I think that is an area that we've been seeing some strength. Look at this one, nice breakout for VIP Shop Holdings. And I like the look of that. Look at this PMO really looking healthy, turning up, you know, gently, which I like to see, even though we saw this rise. It's been pretty crazy. Look at the OBV taking off here. We know we're going to end up with a top above a top, so that's confirmation there. I like to see that. Of course, we already are having a run up of 4 3/4% today, so might be worth while waiting for a bit of a pullback, but I think this one looks pretty good. And if you look at the weekly chart very quickly here, you can see there's a lot of upside potential. I mean, this stock has been up in the $32 range. Now, I wouldn't be looking for that at this point, but you know, the PMO, look at how healthy it is on the weekly chart, and it is rising. And we've just about popped, well, it looks like we popped right above that July mid-2016 resistance. So this one has some pretty good potential, I'd say.
I think this one too. I think we talked about this one yesterday because it was having a really nice day yesterday, and it's part of that media agencies group, I believe. I think that's.
Well, there's one way to find out. If you ever want to know, you can add full quote to your charts, and there you go.
Oh, my bad. Broadline retailers.
Yeah,
well,
I do that a lot.
Very, very hot group for sure.
Absolutely.
But anytime you get a breakout like that and you're in a strong group that's outperforming not only its sector, but also vastly outperforming the S&P 500, I think that, you've got yourself pretty good stock. But
yep,
looks pretty good. I agree with you.
Yep. But with that, it's time to bring in our special guest. Charles Kirkpatrick is here with us. And as you can see, Charles has quite the resume. And honestly, we would have to fill about 3 of these slides to get it all in. So we just picked out some of the highlights. Really, for me, the way I was introduced to Charles was through his book, Technical Analysis, the Complete Resource for Financial Market Technicians, and found it to be very good. It was part of my CMT studies. So with that, let's go ahead and get started on what you have for us today. We're really excited to have you here.
Yeah, hi. I'm having trouble getting this thing to throw my presentation up, but we will do it shortly.
Yes, I didn't. We always have these tech difficulties. It always runs so smoothly pre-show.
Well, yeah, of course, at this point, yeah. All right, well, let me start first. You're going to see in my presentation a lot of, not necessarily formulas, but a lot of assumed correlations. And I just wanted to mention that when I do this, I always do it after having tested everything. I'm a very large skeptic of technical analysis that hasn't been demonstrated to show profits, which is what we're looking for. So please note that when I do say that there's a correlation or there's some reason to be doing this, I've tested it. And if I haven't tested it, I'll say so. Now, let me see if I can get this thing to work.
Yeah, I just got to find that other file you got there.
Yeah. Maybe that's it. I don't know. All right, let me go back to the beginning.
Well, I know that in the meantime, I know our producer, I don't know if you can get some of his slides up for him, but that might be a way to get it going.
How does this look now?
I'm not seeing it. Try. I'm not getting that. Let's see. No, I'm still seeing the other presentation on mine. Zach, if you're in the background there, maybe we can pop up his first couple slides. And if you want to just talk to him through that, that would probably work. Not a problem.
Yeah, I'm so sorry. It's
fine.
It's fine. They can't see what you're doing. We can.
Oh, okay. That makes me feel a lot better.
Yes.
Yeah, I thought maybe what I might do is just grab the screen for a second and then just kind of go over while you're getting that up on your screen, Charles. I'll just show quickly the S&P 500 and where we currently sit right now. One thing, and I don't know, Erin, if or Charles, either one of you have comments, but one thing I find somewhat interesting is the last 2 days we've had these gap downs at the open. And so I think we were kind of programmed with a higher volatility reading that we would just continue moving lower. But yesterday, the low came in the first 5 minutes of the day, and we're seeing that same scenario again unfold today, even after some really bad economic reports came out this morning, or at least economic reports, everyone's saying that higher interest rates are the reason that the market's been selling off. And yet today we got an inflationary report that definitely is going to send higher, rates higher, and, maybe scare some folks. And yet we didn't take out the low from yesterday. And after a gap down, which was fairly well contained, I did see when those reports came out at 8:30 Eastern this morning, about an hour before the market opened, the futures on the Dow went from up 130 to down 350 in about 5 minutes, if that. And so I thought, okay, here we go to the downside. But we managed to hold on, and we're back on the futures, and now we've broken out to recent highs again today on the S&P.
When you look at the bottom line there, the volume, you'll notice that I can't tell whether it's at the end of the day or the first of the day, but every single day has had a big jump in volume.
Yeah, right at the end of the day. Yeah.
Yeah, right before or after that gap.
Yep.
All right. Now I have this thing on my machine, but
okay, then yeah, perfect. Just go share screen. It should come right up there.
Yeah, try it again.
Alrighty, not yet. All right, is that share screen not working for you?
What have you got?
Right now I'm seeing Tom's screen, so we need you to steal it from him.
How do I do that?
Yeah, you should have that green.
There it is. You're there.
Got it.
You got risk?
We got it.
We got your number one slide at this point.
I think our producer put it up there for you, so if you want to just talk to it that way.
Yeah, I would skip through to the third slide. I think it was the third slide that had the risk.
Right, that's what I was on.
There we are.
There you go. Can you see that, Charles?
Yes.
Okay, go ahead.
Okay. Rule number one is you have to be concerned with risk more than anything. In fact, picking stocks, which most people do or spend their time doing, is almost irrelevant. You could throw a dart at a newspaper and pick stocks, but if you are able to control your risk, you'll make money. And so it's very important when you look at any method that the risk is taken into account. Now, on the left-hand side, the wording there, that you shouldn't be spending your time buying, you should be spending your time selling when the risk is too high. And the other thing about risk that confuses people and is a terrible misdefinition is to equate risk with volatility. Risk and volatility are an academic association, but not an investment association. Volatility, well, if you switch over to the middle chart where it shows stock A, stock B, stock A declines by X amount, stock B advanced by X amount. Now, both of those stocks have the same volatility. Which one do you want? You want the B, obviously. So volatility itself has told you absolutely nothing. And but risk then is not volatility. It's basically the odds of losing money. That's what you're worried about. Now, on the right side, there's a chart of the portfolio that are, it's a fictional portfolio that we run. And you'll notice going back into 2008 and again in 2011 and again in 2015-16, where I have the circles, that the ideal portfolio was flat across there. That's because it was out of the market. Being out of the market is extremely important when you're going into a decline. Obviously, during advances, stocks can be non-correlated, and there are people who trade that, but being non-correlated means that you use relative strength to pull out the ones that are the best, because basically stocks are going in all directions. But when you go into a decline, all stocks become correlated, and they're correlated in the decline. So that's evidence as to why you should not be anywhere near a stock in a decline. Now, next one, I don't know whether you do it or I do it. Capital loss. The other problem with loss as a risk is that you also lose time. And if you can sort of envision this is the last 10 or 12 years in the market. And really, if you started in the year 2000, that's and gone all the way to 2013, you haven't made a cent, and taken a few hits in between, a few scary ones. So, and it's going to take a long time, or well, when you have the corrections, as you did say in 2000 to 2003, it takes you 6 years to get back even. So you don't want that. You want to be out of the market. You want to be in cash when the thing makes the bottom, and so that you can add that leg to your portfolio profit, not consider it as a return of back to where you were. All right, and the basic things that I look at for market timing are these three mentioned. Sentiment is I look at, but sentiment is more short term, and well, for that reason, it's not as useful. The only aspect of sentiment that lasts for a while is, and it's really included in the money section here, is margin debt. Margin debt takes a long time to develop, and right now it's at historic highs, so it's telling you that you're in a speculative market. But we know that anyways, just from the price curve. So money is the second one, and I have a chart here of this, the S&P 500 relative to the Treasury bond, and the old rule of 3 steps and a stumble, which goes back way back, and it was just triggered here this spring or this winter when the Fed raised rates 3 times. That's almost an infallible indicator. And then, of course, the technical is what I really focus on, because that's what I experiment with. And the old moving average crossovers are adjusted for duality and they're filtered. We'll get into that a little later. And then using the Wilder Directional Index, which is called the DMI, that is extremely good in timing. Next chart, I throw up the Fear and Greed Index. Now, I noticed in the paper this morning that, and you'll see that the first of the ingredients of this is market volatility, the VIX, and the SEC is going after somebody, I don't know who, for manipulating the VIX. Even so, it's a function of the volatility in the S&P, and I don't know how you influence it except over very short periods. So those are there's a list on the side there that shows the breadth and the market momentum and how they calculate it. It's done by CNN Money, and at this point it's very low, showing extreme fear. So again, that's suggesting you're in the midst of a rally, but not necessarily a bull market. Now, this is the ratio of the Treasury bond interest rate, 30-year rate, the TYX, and the SPX, the Standard & Poor's 500. And there's a direct relationship there that when the moving average of that index turns up and the index itself, in other words, the ratio crosses over the moving average, you get a buy signal, and conversely for the sell signal. And this chart shows the results of that. And we're still in a buy frame, as you can see. The last buy was back in 2015. So money supply, or money, is sort of somewhat bullish, but old, it's aging, let's say. The high margin debt is not good, and you had the three steps and a stumble. So 2 out of 3 are negative. Not convincing quite yet, but we're getting close. Now, in the technical aspect, I use what's called a dual filtered moving average crossover system. The dual means that when you look at the moving averages, one moving average is not necessarily good for both buys and sells. The reason being is that the character of the market is quite different when it's in a decline than it is in advance. And sells, when it's in a decline, for instance, you'll have spike bottoms usually, and you'll have rounded tops. Now, a moving average, in order to trigger on any one of those, has to have a different period, a look back period. And so the dual means that there's one for buys and one for selling. Filtered is just merely a means of reducing the whipsaws you often get in a moving average system, where it just goes below, for signals a little thing and then suddenly whips up. Well, if you add a filter, in other words, a certain amount by which it has to go in addition to the crossover before it signals, then you reduce those whipsaws. And again, this has all been tested, and I also use walk forward optimizing, so that it's usually pretty good for the next, in this case, probably the next year. And then the moving average crossover means that if you're looking at the buy line, you're only looking at the times that it crosses up through the one line, and you get a buy signal, which you had back in April of 2016, and you haven't had a sell signal since. So that's looking favorable. Another method that I use is that's sort of a reduction or a rearrangement of the old DMI method of Wilder. Wilder's invented some really magnificent stuff, but in this case, the DMI is really two indices. One is, and you can see it at the bottom of the chart, the blue line, squiggly line, is equivalent to buying pressure, and the red one is equivalent to selling pressure in the market at each instant. And obviously, when the buying pressure crosses the selling pressure, that's usually a time when you want to be long, because it means that the trend has reversed upward. Now, the conventional way of doing that is with what they call the ADX. And what I do is, instead of using the ADX, I measure the spread between the two, the spread between the buying pressure and the selling pressure. And when that reaches a peak, that usually occurs at some kind of turning point, and you don't know what the turning point is going to be until it begins to contract. And by testing, you come up with the amount by which it has to contract in order to give you a valid signal. In this case, the buy signal was way back in, April of 2017. And you can see the little blue arrow there. And just on the decline here a couple of weeks ago, or a week or so ago, you see the red arrow, and that's where you got a negative crossover. So that means for the intermediate term, you should be out of the market, or at least very cautious in what you do. So once you know that the market's going up or down, or you expect it to be going up and down, your next problem is finding out what you want to put your money into. And you only do it when the market looks favorable. And what I've found, and it's probably the only method that has been, not authorized by academia, but academia has a terrible time with it, because, as you know, the efficient markets hypothesis argues that there is no formula that can beat the market for selecting stocks. Well, that's a problem in this case, because they have demonstrated even themselves that the relative strength works. Now, the variables, of course, are different. It depends on how far back you're looking for the relative strength, how you're constructing the comparison, and so forth. I use two methods. One is called the Levy method, and what that does is takes the ratio of the closing price of every stock and a ratio of that closing price to the 30-week moving average of that stock gives you a number, that ratio. Obviously, the stronger the stock, the higher the ratio. That is then ranked, and or that ratio is ranked, and those stocks and divided into percentiles so that it makes it easier to figure out what the relative what the relative value is. And through experimenting with here, let me show you the next one. This is a graph of the relationship between the relative strength based on that Levy method and the post-performance 3 months out. It also works out 6 months, 9 months, and 12 months, but this case is more dramatic with 3 months out. The graph is sloped upward, and the bottom is the ranking, the percentile that I mentioned. And you can see that the high percentile, where it was 92 to 97, really 97, the performance, which is on the vertical axis, is the highest. And then it goes downhill as your relative strength itself goes downhill. So very simply, it's telling you that you want to buy stocks that have or exist in the top 97th percentile up. The high number is 99. So 97, 98, 99. Those are the stocks using this calculation that you should consider. Now, there's another way of looking at relative strength. Oh, I'm sorry, I jumped ahead a little bit. No, I didn't, sorry. There's another way of looking at it. For you as an individual, it's very difficult to come up with a ranking system because you have to have a computer that sorts large numbers of data. So I found an easier way of doing it, which you can do on an Excel sheet, and that is just to take the ratio of the close to a moving average, and then using that raw number as a guideline as to whether you should buy it or sell it. It turns out that when you do this, well, for instance, the relative ranking system produced about a 28% CAG, which is a compound annual growth rate. And when you do the absolute, which I'm trying to describe here now, you do a 25% CAG. So it's not quite as good as the ranking method, but it's a hell of a lot easier to calculate. And you can use this at home. What you need to do is take a ratio, as I said, and the ratio is the close to the 61-week moving average, and it's the SMA. I don't use the exponential or the or any of the others for that matter. The results are more or less the same. And in this chart, you see Weight Watchers International, and the blue line and the red line down there at midpoint are the ratio level at which if the stock breaks up through that level, that ratio, is a buy. And then if it goes through the red line, it's a sell. Now that number for the buy is 1.47 using that ratio. You want a stock that has that number if you can't calculate the relative strength. And you can see you get the buy signal in Weight Watchers way back in April at roughly $20. And it has so far failed to decline below that low red line. So it's still a worthwhile holding. Now, next question then is, okay, you own some stocks. They all work out on the relative or the absolute relative strength method. When do you sell them? Aside from when the longer-term market indicators go negative. You sell them when they either hit the levels that I mentioned in the ranking system. If it goes below 58, you want to get rid of it. and in the absolute one, if it hits 1.04, and then you want to get rid of it. You should never have a stock with that as a ratio. The other method is a classic old chandelier stop, which is a stop on your price that's regulated or includes the average true range. Again, another Wilder invention. And when you're testing it, there's two variables in the chandelier. One is, of course, the look-back period, and the other is how many look-back period for the ATR, the average true range, and the other is how many of those particular ATRs do you need to get rid of the stock. This particular one right here is 17 weeks back, and it's 3.1 ATRs, and that is subtracted from the high. You never lower the stop level, or even if the volatility dies on you. All that will do is bring you down closer to the stop level, but it will never. You never want to have it so that it breaks, or the stop level goes down. If it goes through it, well, then you sell it. It's simple as that. And then the final is this is the list of, or the beginning of a list that I publish in my Market Strategist, and it shows the stocks that are added, subtracted, the bargain list, where they were bought, and so forth. It's just a history, and that's what goes behind that chart that was on the first page. I don't hear any question. Yes.
I'm kind of looking at this stock selection and exits slide that you have up here, and the last one gets my attention. I'm sure it gets a lot of folks' attention. Sell all stocks when a majority of long-term market indicators show a bear market approaching. When you talk about your long-term market indicators,
right?
Everyone gets scared. I mean, we saw the last 2 weeks the market takes this big drop, and of course, anytime we see some selling, there's going to be an immediate debate: is this bear market starting?
Right.
What types of long-term market indicators are you referring to there?
Well, certainly the money aspect. Well, actually, all of them. They all. What happens is that different tops have different characteristics. The top that we've just gone through is a classic speculative market. You have a accelerating upward curve in prices. You have a tremendous overbought. You get tremendous enthusiasm, optimism. Money starts to tighten, and then it breaks on a first break. But people have to remember that even in 1929, it took 3 years to get to the bottom. So most declines don't go from top to bottom, and if they're going to be a very deep one. So by understanding how these particular kinds of tops work, the surprise. Oh, and the other thing is that usually you get a big sharp down off the top in a speculative market that nobody can understand, and I haven't heard a good explanation yet as to why we suddenly took out the amount of points that we did. But classically, you then have a rally, and as you have this rally, you'll see the longer term, like the dual moving average filter and these sort of things, begin to turn down. They've already started to turn down, but they get down to that sell point, so that when you break on the next decline, and that could be, anywhere from 3 months to next fall sometime, or not maybe 2 months until next fall. At that point, then you've now demonstrated that you definitely are have made a long-term top, and that's when you want to get rid of everything. The thing is, while you're at the top, relative strength continues to make money for you. It's the majority of stocks may be peeling off, but the relatively strong ones are the ones you want to stay in because they continue. And you pointed out a few today that I think VIPS was one, and I forget, there was a couple of them that were making new highs. That's totally characteristic, but that list of stocks making new highs will start to shrink, of course, as the rest of the market weakens. And so that's what we're waiting for now.
Okay, so do you, at this point, are you ready to say that we've started a bear market, or are you saying that there's still not quite enough evidence out
there? I want a little more evidence. I'd like to see that rally that we're presumably starting now, or have started, and just see what happens to it. Yes, I mean, I think personally, I think you've seen the peak, but I can't confirm it yet. You got to wait for that rally to see what happens there.
Okay. Well, it's just pretty interesting. I mean, this has been obviously a pretty big discussion that we've had on the show for the last couple of weeks with the big drops and the volatility spiking. And of course, you have to have some fear in order to get the market selling the way it's sold. And so the question is, I mean, we've had some of these spikes in the past where we've seen the fear, but it's been a correction as opposed to a bear market. And
that's correct.
What happens from this point forward really is going to give us more indication of what we're facing.
Yeah, the difference this time is that you had what's called an accelerated curve. And they're characteristic of speculation. Now, can we go and speculate some more? Well, I suppose we could. But they're the panic in reverse. A panic usually starts off relatively slowly and then, falls off quicker and quicker until it hits the bottom. Whereas a speculative advance has this sort of slower at first and then gradually accelerates up to its final peak. And then you get a big smack off of that peak. You never know beforehand where the peak's going to be. But when it does smack, one of the characteristics, as I think I mentioned, is that nobody can understand why. It's a total mystery. And it's sort of like 87. Nobody could figure that out either. Still can't. But can you later on, out 3 or 4 years, continue up? Of course, that's possible. What you're worried about is the next few years.
Okay, well, we have gotten to a pretty good point, but there was one question that came in that I saw in the chat room, and I don't know, Erin, if you have others, but one question in particular was asking about the books, your books, and I know we have your books in our bookstore, but how many books have you written?
Well, on the market, 4. I wrote a hunting guide once.
Oh, awesome.
Book.
Well, I do.
Maine and New Hampshire. And
is this hunting for stocks, or are you talking about animals?
No. I'm talking about furry animals and fishing.
Okay, I got you.
Well, we have a lot of interest in some of these studies that you're showing us. And should we just direct them to your website at charleskirkpatrick.com where they can?
Yeah, that's probably the easiest. Yeah.
charleskirkpatrick.com. Right. There you go, guys. That's where you can get most of this information, I would imagine.
And I know you've got probably a lot more that you could share with us, Charles. We'd love to have you back if you have some time in your schedule. Would you mind coming back and joining us?
No, I'd love to do that. Thank you.
That would be awesome. I mean, I know you've got other things that that interest you in the market, and a lot, obviously, in your books. You got a ton of information that folks really should pick up a copy of your books and take a look at. So we'll definitely have you back for that. But I think for the 10 in 10, you said this morning that you would stick around and maybe just give your opinion on some of these stocks if something looks interesting. So we'd love to have you stick around if you could. Okay. Yeah, happy to do that. Thank you.
Yes, we have people in the chat room already saying, yes, please come back.
Well, it's hard to put that much information into the short period I had.
Yeah, I know how that goes.
Yeah.
I know we got we do 10 in 10, Charles. So we have 10 stocks that our viewers submit. Erin's going to take a look at those and go through those in a RRG chart.
Well, that's what I'm hoping to do anyway.
Okay.
Go ahead and see if you can take the screen, Erin.
Yeah, I just I'll admit I've been paying so much attention to the presentation. I actually didn't get all of them typed in to a chart list. So
well, that's very flattering.
Yes. Well, it's very true. Okay, so Let's go ahead and share what I have, though. Let's just get started. I could show them how to put them in a chart list real quick, but I'm just not, because we have to get moving here. So the first one was going to be Ultimate Software Group, ULTI. So go ahead and grab that.
All right, I will. And let me pull up the chart here. And everyone should be able to see Ultimate. Actually, I like what it's doing today. It's after a false breakout about a week ago. It's trying to make that breakout today on a closing basis. So for those of you who are candlestick fans, from my analysis, I don't like seeing a breakout into territory that would have been a new closing high on major volume, and then have that breakout fail into the close and close back beneath it. I think that is a short-term negative. We did pull back from that over the next couple of days, but here we come again. And volume today is lighter than the last time we tried to make the breakout, but it'll be interesting to see if it picks up into the close as we attempt to make this breakout. I think a close over $233 would be bullish here on ULTI. What I don't want to see is another failed breakout. It doesn't mean that we won't eventually break out, but just in the short term, a failed breakout could maybe lead to another 20-day test. So I would kind of hold off on Alti at this point, make sure we get that closing breakout.
All right. Let's see, ING. We haven't looked at that.
Let's see here, ING.
Mm-hmm.
All right, so it's in the financial space. I'm imagining that it's probably done. Oh, this one's pulled back quite a bit after a huge move up back at the beginning in January. So I think it's pulled all the way back down to a key support level. So again, this is one that I would annotate by the support resistance line. You can see that that was a key low that we had tested a couple of times back in November and early December. And off of all the selling that we saw for about 3 weeks, we went all the way down within probably 5 cents of hitting that support level before bouncing. It looks to me like right now, I would say that the stock is trapped between support around 1770 and the moving averages, which are both up at around $19. So that's the trading range that I see for now.
Okay.
Looks like a loser to me.
That's the quick and dirty. I would agree with you.
Let's just be blunt here. Okay.
Actually, if we let Charles do it, this could be like 10 in 3. 10
yeah, exactly. Excellent. All right. Well, let's take a look at, let's see, SEDG, Solar Edge Technologies.
Yeah, I actually owned this one for a little while, made a little money, got out, and didn't like what it was doing, falling apart. Went a little bit below gap support. This could be one of those springs that Bruce Frazier likes to talk about with the Wyckoff approach. But you can see that there was gap support, huge gap up on very heavy volume back in November. You can see that we also had some lows that came in, reaction lows after that gap up. So this was a key area of support. And notice, the one thing I do like about it is, again, you've got that long tail to the downside. So intraday on heavy volume, there was a lot of selling going on. And who in their right minds would be buying a stock that's selling off like that? Normally, if you get a tail, it's an indication that maybe you've got market makers that are increasing or taking on a trading position in the short term. And we have seen nothing but strength since. And I would say right now, overhead resistance is up at about the 37 level off of the recent high. You could start to make an argument now for an inverse head and shoulder pattern. Left shoulder, left side of the neckline, the head, right side of the neckline. If we get a pullback maybe to that 20-day moving average, could have a really nice bullish pattern setting up here on Solar Edge Technology. So I like the recovery here, and I'm beginning to think more like the Wycoffians and Bruce Frazier when it comes to some of these really quick failures to hold support and then bounce back. I think that there's a lot of substance to that theory.
All right, let's see the next one. Let's make that TLND, Talend.
TLND.
Yeah,
Okay.
Haven't looked at this before, I don't think.
No, I don't remember looking at this one. Well, so far, I want to see how this finishes. First of all, the stock's up 10% today, so it's kind of hard to do much with it if you're not already in it. But I don't like it when you get the big gap ups with heavy volume and you fail. And I could just point really quickly to the one that we saw not that long ago back in November. And I'm not sure if this is earnings related. Maybe both of these are earnings related. But there you had a huge gap up. And again, these any of the filled candles, you're opening up at the top of the rectangle and you're closing at the bottom of the rectangle. And then the tails out the end actually show your intraday high and intraday low. So a black filled candle here is, and the difference, again, for those that aren't candlestick fans, the difference between a black filled candle and a red filled candle is the black filled candle still closes above the prior day's low. A red filled candle closes below the prior day's low. So if you're just out all day and you come home at the end of the day and you see this stock, it's going to be, you're going to have your portfolio rising if you own this stock, even though it was way down from the open. That's the difference between a black candle and a red candle. But what it does mean is that when you got heavy volume and a big open like this, everybody's excited at the open, but there's not enough demand to drive the stock higher after the open. And so when you get these big black candles like this on heavy volume, normally I look for additional selling. We saw it back then. And so right now I'm going to say I want to see some more buying into the close today to be short-term bullish. If we see a big black candle off of this uptrend, then I would be maybe looking back toward these moving averages. So this is one of those I'd have to see the rest of the action today, but I'm a little suspicious right now.
All righty. Let's see. Next one. How about WYNN? WYNN.
All right. Well, WYNN at this point, well, if you're in it or thinking about getting in it, it could be a win-win. I couldn't resist. You've got price support. I mean, this one's not performing well on a relative basis. I think that's pretty obvious. I think it was the sexual harassment charges against Steve Wynn. The stock really fell apart. Steve Wynn later resigned. He got that gap up when he resigned, but now we've pulled back and again threatening this 160 level. I'd be real careful if Wynn breaks below 160 on a closing basis. Otherwise, I think you've got a wide trading range and you're close to support. So I'd be okay with a long position, but I would really have a tight stop on this one going forward.
All right. Feel free, Charles, just throw in there.
Yeah, okay. No, the prior one looked like it was a news announcement of some sort too.
Mm-hmm.
Yeah, it's probably earnings. Just looking mid-February, also mid-November, we had the same thing. So this must be their earnings time.
It's always wise, I think, to go and look at whatever news is out and see if it's directly related to that. If it's without news, that's what you want. If it's with news, yes, probably you should be doing the opposite.
All right, let's see. Next one, it's called Real Page, and it's RP. My PMO is decelerating. It wants to turn up. Decent scooter, but
I like
not doing much yet.
It made a breakout, and it's gone back down and tested the breakout. So I'm okay with it right now. We've got obviously a stock that's been trending higher. It made a big breakout, got very overbought. You can see the RSI was up into the 70s. There was also a negative divergence when we saw, again, this long tail to the top. Intraday, very heavy volume, up at 51 and change, getting close to 52. And we came all the way back, closed at 50. A little bit of a shooting star candle with a negative divergence in play. And then the selling kicked in back to the 50-day moving average. You see that PPO moving back down close to the 0 line. I think it's consolidating the gains from a breakout above 46. I think 46 will hold, and I look for the stock to go back up and challenge the highs.
Even though it may be looking strong on a relative basis, it's not doing anything.
Relative to the benchmark, or? Yeah,
well, either one, but because you've got a range here of 46 to 50, 51. I mean, there must be hundreds of stocks that have had a better run than that. Mm-hmm. So this has got to be maybe the middle of the pack, even though it looks fairly decent.
Mm-hmm.
Yeah, one of those where maybe it's like you said, it probably isn't. Well, it definitely isn't among the best. We've seen some of the broadline retailers and some of the clothing and accessories companies actually breaking to new highs. So they're definitely better stocks in better areas out there. But as long as, if I'm interested in this stock, I think as long as it holds $46 at price support, I'm okay with it. And I'll give it some time to see if it resumes that relative strength. But definitely point well taken.
All right. How about Bluebird Bio? Blue.
Yeah, Blue was actually pretty good biotech for quite a while. Biotechs have struggled. And I like the fact that this one is performing well relative to the overall biotech group. It's not far from that recent high. And again, take a look at that black candle. Started rising, gapped up, heavy volume, black candle, put all the way back down into the gap support area. before resuming its move to the upside. I like the uptrend. I still like biotechs. I think biotechs will lead, but we've got clear resistance now marked at the top of that candle from back in December right there. So 220 is going to be a target of mine on a short-term basis. And I think the low right before this move to the upside, I think is key support. We got down close to it, didn't quite go below it. And so now we're just sideways consolidating. I think eventually we'll get a breakout here on blue, but it may be may take some time and might wear your patience a little bit.
All right. Just like I said, Charles, just feel free. You're not going to interrupt anybody. The next one is going to be UPS. And, I looked at that as that falling knife sort of thing. But I can see, when I looked at the weekly chart, I mean, there is some support here between 100 and 105.
Well, this one's interesting because Amazon made an announcement. They're getting into their business, basically. So FedEx and UPS both took a pretty big dive. But if you recall, it wasn't that long ago that Amazon, when they bought Whole Foods, you remember all the companies that were hit on that news. Many of those companies came roaring back after that. So I'm not sure. I think in the short term, you got to be really careful. Obviously, on a relative basis, as Charles, I'm sure, could point out, this is not the kind of stock you want in a market that's been still hanging in pretty good. This stock's not only going down and performing extremely poorly on a relative basis, but check out the volume. There's a lot of distribution taking place. So I'm not in any way suggesting that I would be running into UPS at this point, or FedEx for that matter. But I do think that at some point this is being overdone, and I'd expect at least a bounce back up at some point to test that declining 20-day.
Okie doke. Let's see. Anything else? Let's see. GT would be the next one. And that is Goodyear.
Yeah, it's not been a good year so far for Goodyear.
Not really.
It's been a bad year. They may have a name change coming. But yeah, they got off to a good start in January, but they are hitting key support from November. So again, from a technical perspective, this could be an area where we'll see at least a little bit of buying, but it's not, again, it's a trading candidate to me, not one that I would be comfortable holding longer term, because I just don't like the way it's trading on a relative basis. There's been too much movement to the downside, but short term, I could get in because I can keep my stop pretty tight. I can, manage my risk to the downside, and to the upside, that declining 20-day. You can see as we've moved below it, we haven't been able to get back up above it. So any test of the 20-day would be a sell for me on Goodyear.
All right, we have one more, and I know it's one you don't like to look at, Tom, very, very often, but
Gold.
It's always big on the ticker cloud. JNUG, JNUG.
Yeah, this is the junior gold miners, bullish 3 times. It's having a really good day so far today. I am just not a fan of gold. And so if I'm not a fan of gold and I want no part of it, I certainly don't want 3 times of it. I don't want to triple. And I could pull up a lot of charts, but I'll show you one real quick here. That is the reason why I just don't want any part of gold or gold miners. And I've brought this up many times, but let's go back. Let's take a look at the weekly chart. Gold versus the S&P 500. I'm going to add something to it as well. Let's go back. I'm going to go all the way. I'm going to go back 20 years here. So this will be a big chart.
Yeah, take a look at gold too.
Yeah.
GLD.
Yeah, let's take a look at, I'm going to put the dollar in here. And I'm going to put gold. Well, we have gold relative to the S&P. So let me go ahead and put this in here. The problem with gold, and the biggest problem I have, is that while gold was rising, this is gold rising relative to the S&P 500. As a trader, what I'm interested in is beating the benchmark S&P 500. If I can't do that, then I might as well just stop trading and put my money in the S&P 500. I mean, there's no point if you can't beat it. So what I'm looking for as a trader is something that beats the S&P 500. When the dollar is declining, gold continues to perform very well relative to the S&P 500. But when we put in this double bottom and we started rising on the dollar, take a look what gold has done relative to the S&P 500. And even the last 14 or 15 months of the dollar declining about 12%, we're not seeing any outperformance in gold relative to the S&P 500. So, and I could change this and maybe, what is it, GDX is the miners?
Yes, GDX.
So, I mean, if we take a look at GDX versus the miners, we've basically got the same thing. We're moving lower. The dollar, now the dollar to me is at a major support level. If the dollar starts to bounce, I don't see how gold performs well. And even if the dollar breaks down, the dollar's been declining for 14 months, and gold miners can't get out of bed. So this is just not an area that I'm interested in. And so to play this group with a triple, leveraged ETF, I'm just not a fan, because again, I'm not bullish gold. I wish I was, and I wish, that, and I hope that if you own that JNUG, I hope it does well, but it's just not a strategy for me. I just don't like the way it's traded.
All right. Well, that's all we've got for our 10 and 10. Very nice. And thank you for putting in your comments here and there, Charles. Really appreciate it. We did get somebody in the chat room saying that they just bought your book, the 3rd edition. I realize I only have the 2nd edition, so.
Oh, dear, you got to get the 3rd.
Yes, maybe I can wrangle a signed copy out of you at one point.
Yeah.
All right. So with that, let's go ahead and we're going to switch over.
Yeah, give me your address and I'll send one to you.
Awesome. I will do that at the end of the show.
Okay.
Very excited to see that.
I'd like one too, while we're at it.
Sure.
Yeah, Tom.
Yeah.
All right. There's the 10 and 10 symbols that we looked at today. And now I'm going to take you very quickly. I wanted to talk to you about something that is coming up. ChartCon 2018 is our big conference that's coming up. We're talking about reducing risk in uncharted waters. And the cool thing is, guys, is you can attend it online. So very similar to how we do the show here, where you watch it and you can rewind it and that sort of thing. You're going to be able to do that for ChartCon. We did this last time in 2016. It was super successful. But if you really want to join us live, we would love to have you. You can you can look at our VIP packages if you want to come and join us during the conference or on the cruise that will be happening to Alaska after the conference, and rub elbows with the likes of Tom McClellan and Tom as well, Arthur Hill. Lots of us will be there, so highly recommend you check it out. And again, here are some of the speakers we have for both days, so it should be a great time. But with that, I'm going to go ahead and move us right into the market update. Let's see what's been going on so far. I'm going to take you over to our candle glance because that's the best place to see everything all at once. And you can adjust these. I usually add the TSX in here for our Canadian friends. And here we go. So right now, as we can see, we were talking about this at the beginning of the show, lots of gap downs or starts at intraday lows and then working our way up into the intraday highs. Currently, we are flirting with intraday highs where, we started the day down. Looks like a lot of consolidation during the show, and now it's starting to take off. And we can see that with technology, small caps also, although it looks like they're trying to consolidate a little bit or maybe take a pause. And as we can see, Treasury yields are up, currently reading 29.06. UUP is down. But notice this morning, big gap up, and now it has just been falling. It tried to make a recovery, but it didn't quite make it. We're now sitting at intraday lows at 23.29. We've got commodities rising. Likely part of that would be oil being up. I see a little bit of a double bottom here on the intraday chart. Look for a breakout and possibly a move higher. And we've got gold also rising. It took some time consolidating, but it is now sitting at intraday highs, reading at 128.14. VIX is lower. Our last reading 1931, so it's really coming down out of the really high readings we've been seeing in the 30s and 40s. And certainly it's still higher than what we were seeing during most of this year, where we were looking at readings between 9 and 12. So seeing some action on the VIX has been very interesting. We can see that advances leading declines as of yesterday's readings. And let's go ahead and take a look at our market summary. I want to show you the industry groups that are leading and those that are suffering. And what we can see currently on our sector spiders, financials are doing the best in consumer discretionary, technology. All of these tend to be your more aggressive sectors. You would see them lead when we're in a good market situation or a bull market situation. Utilities, the only laggard right now, down 0.37% currently. U.S. industries, gold having the best day, up over 5% on the XAU. Biotech's hardware right behind, and banks all up over 2%. And we can see utilities and REITs are the laggards. And as far as international ETFs, China, South Korea, it looks like the Asian and emerging markets out there are leading. And we can see India is the laggard, but it's still up 0.3%. So it's reading $87.34. And with that, I'm going to complete the market update. And we can get into some of our under the radar stocks. Did you want to start off with that, Tom, or should I?
No, go right ahead if you're ready.
I do have the screen, and you know it doesn't always like to share. So I did a scan, and I was looking, and the tobacco index came up. I don't usually get indexes, but the particular scan I was running, I didn't say type stock. I did include some of these indexes, and the tobacco index came up, and I thought that was really interesting, seeing that breakout after a really nice move here to the upside. So a PMO buy signal that came in just above the zero line. It looked really interesting to me. So what did I do? I went to the industry group page here, the industry summary, and decided, well, I want to look at tobacco. All right, well, that is under, interestingly, consumer staples. I guess it's a staple for some folks. And I went ahead and clicked on the tobacco, and I got all of the stocks that are in that industry group. So I took a look at all of those, and this is where I came up with, I decided to look at 4 of them I thought looked interesting. So I'm going to just walk you through these 4 very quickly. All right, so Philip Morris was the first one. And as I said, a lot of these have PMOs now that are either on buy signals or turning up. I love the way this PMO is turning up. And look at this beautiful positive divergence. I'm going to even annotate it for you because I think it looks really nice. So we have right here, rising bottoms on the PMO. And what happened between here and there, the bottoms were lower. So that's a beautiful positive divergence. I like to see it. Right now, I would say the only issue is this area of overhead resistance here, and it's bumping up right against it at these lows from earlier in the year. So I thought that one was pretty interesting. I thought that might be something you could consider under the radar. Usually wouldn't come up on my scans because the 50 is below the 200-day EMA, and I prefer to trade stocks that have a long-term trend model buy signal, and that, of course, is the 50 being above the 200-day EMA. All righty, let's look at TPB, Turning Point Brands. This one I thought looked somewhat interesting, but I'm not seeing kind of the action that I saw on the PMO on Philip Morris. And the 5 is about ready, though, to cross above that 20-day EMA. I think there's some interesting it's an interesting consolidation area. I think you could still pull out maybe $1 or $2 before you hit that overhead resistance. Thought that was interesting, but I like to only get involved in stocks that have a rising PMO. That's my particular trading style. Universal Corp, we got the PMO buy signal on this one. Scooter has been trying to improve. OBV, you've got tops rising here, and you have tops that are falling here. So that would be considered a positive divergence. We have a breakout in the making above this declining tops trend line. So again, thought that was interesting. Got a 520-day EMA positive crossover on that one. And finally, Vector Group. Here we go. PMO is starting to turn up, and it's doing so in oversold territory, so even better. The only issue is this area of overhead resistance, and you can see how far back it goes this year, that this is pretty strong. and it's already had trouble getting above it. But this PMO turning around tells me to keep an eye on this one. If we get the breakout, I think that it could certainly run. And those were the under the radar stocks that I had. So, Tom, I'm going to hand it back to you so you can get yours in.
Yep. I'm going to take a look a couple of things first. I've got a couple of stocks I'll go through, but I want to show you one other thing first that I think is under the radar, but it's not necessarily in terms of individual stocks. But let me show you first thing that I was looking at. A lot of people, I haven't heard anybody talk about this, but since the market's been struggling, I pulled up the XLY XLP ratio. And of course, if you follow the way I look at the market, this is one of the more important ratios that I like to follow in terms of the intermarket, looking at different sectors, because the XLY is the aggressive part of consumer stocks and the XLP is the defensive group. And so in January, when the market was taking off, money was rotating into the aggressive area. But what I find really interesting and maybe a little under the radar is the fact that the market's been selling off, and yet on a relative basis, consumer discretionary continues to break out to new highs against consumer staples. I think that is one really bullish part of what's happened here recently that I don't think a lot of folks are really considering. I love to see the money rotating into a more aggressive area as the market consolidates, especially if the market were to break out. I'd like to see this continue. So I think this is one thing that's under the radar. I'm also going to mention, and we're going to take a look at another ratio that I like to follow, and this is the banks versus the REITs. Because banks tend to do better in a strong economy, and the REITs tend to do better in a weaker economy. And check out what's going on with the banks and the REITs. Same thing. During January, when the market was moving higher, we saw exactly what we expected, banks outperforming REITs. But during this pullback, you'd think more money would rotate towards safety, and the REITs are the safer component. And yet we see banks breaking out relative to the REITs, which in part are due to higher treasury yields, no doubt about it. But I find this particularly bullish as well. And then finally, and we've talked about this a lot, so I'll just spend 1 second on it, but the Russell 2000 relative to the S&P 500 bottomed back at the end of January. I don't know if this is going to hold, but I do think this is important because that's when the dollar bottomed. And if the dollar's down today, but if the dollar holds that recent support level and does start to rise, I would expect to see small caps, which have totally been under the radar for a while now, maybe begin to outperform for a more significant move to the upside. So I think those are some things, just some underlying themes maybe to keep in mind as I go through some of these stocks. But I'm going to go through quickly GNC. This one actually is, I want to get off let's go back to candlesticks here. This stock's been in a downtrend for a while, but you can see that there was massive buying back in mid-January. That's a really nice bullish hollow candle on the heaviest volume by far on the chart. And then we had another gap up yesterday on heavy volume, but there's the black candle. And look at the follow through. It's more downside. But I do think as it gets close to the moving averages and maybe the price support area around 4, I think GNC is one that's been under the radar for a long time, because we could talk about a weekly chart that looks really ugly. I mean, here's a nice ski slope for those of you following the Winter Olympics. GNC certainly doesn't look good. But notice, to me, it looks a little bit like what it looked like in April, where we made a move up, we failed at the 20-week moving average, pulled back, and that then provided a nice little low for a little bit more strength going forward over the next 3 or 4 months. Here, we put in a low. Right now, we're failing at that 20-week moving average, very similar to April 2017. Maybe we get a pullback, put in a double bottom, and then GNC could be in position for a move to the upside. Just, something that I think looks interesting, maybe worth keeping an eye on. BLDP, this is Ballard Power Systems, another one that's in the downtrend. We did put in what looks to me like a double bottom, and we rallied strongly off of that with big volume. And now we're coming back up again on volume, trying to get through this 20-day moving average, which has been a bear for BLDP over the past several months, or at least the last 3 months. And so I think BLDP is one maybe to kind of keep an eye on. Hubs, this is HUBS. This is HubSpot. This one is failing so far at the breakout, but this is one I'd keep on my radar because it's got a nice uptrend in play. When it came back down a few days ago, you can see it held the prior low and that prior high. So it hit support, quickly rallied. I think it's in a trading range. But the fact that it's trying to make a breakout when the market's nowhere near a breakout, I think says that, maybe this one's got some real strength under the radar. And look at the volume, which has been strong as well on this move to the upside. So I think there's some accumulation taking place in HubSpot. OMC, this is Omnicom Group. A beautiful move up here. I do want to take a look at the weekly chart here, though. On the daily, clearing some major levels. Weekly, we still got some overhead resistance that we need to deal with. But at least on the short-term basis, getting back up above the 78 level, I think is pretty interesting. And then the last one I have is TWLO. This is Twilio. And I'm bringing this one up on a weekly chart because if you look back throughout 2017, I think it's pretty clear that when you get up to 32.5 to 35, that's where we cannot get through. So you're looking at this week's move, which is 27%. But just be careful because we are now moving into this territory where the stock has had a lot of trouble getting through. The good news would be if with this kind of volume that's been coming in, if we can somehow continue this push and get through $35, I think this is one that's been under the radar for quite some time that could have a run in it. So TWLO is another one that I would watch. And that is it. Wow. So quickly summarize our under the radar stocks. And there you have it on your screen. I don't know if we still have Charles, but if Charles, is there anything under your radar right now?
Well, I approach it differently than what you do. I mean, I'm very interested in what you're doing, but because my screens are all based on relative strength, I only look at stocks that are actually the best performers in the market. And it's very rare, except when they are added to the list, that there's any kind of, now I comment on the patterns that I see, but I don't necessarily act on the patterns unless, for instance, the ATR stop, the chandelier stop is broken or things of that nature. But I just approach it differently. I go strictly relative strength. And I noticed that while a lot of those that you mentioned look very attractive, I don't question that. My only question is where do they rank versus other stocks?
Yeah. So would it be safe to say that pullbacks in stocks like Amazon would be kind of stocks that you would maybe look at as under the radar? Kind of.
Well, surprisingly enough, Amazon's not one of the strongest stocks.
Oh, okay.
It's very. I mean, I'm brutal in this. This is very. Run through all the statistics and so forth.
Do you, by chance, have a stock or two that you think, based on your numbers, are among the strongest stocks that we could give to everybody?
Well, I can mention there were a few that were added this weekend.
Yes.
And one called Array Biofarmer. I don't even know what these things do.
That doesn't matter.
I know I agree.
ARRY. Yeah, it's a video game.
Array. Okay. ARRY. Yeah. There you go.
There's your helpful hint. Well, it's been absolutely a pleasure to have you here, and I'm so glad that you've said you will come back. I guess we made it not too painful, so that's excellent.
No, not at all.
So very much looking forward to your return, and we just wanted to give you a big thank you for coming out and talking to all of us.
Well, thank you for inviting me to your show.
Yeah, you definitely have an invite anytime you'd like to come back. And you may want to even check out the show on Friday because Erin's going to go through her bull and bear market strategies and rules, which I think will be.
I don't want to be graded by the professor. I'm already a little bit. Wow, I hope I covered everything the right way. Yeah, I don't know about that, but sure, of course, you're always welcome.
No, I'd never embarrass you.
So anyway, what do we got coming up though this week? Do want to make sure we get all of this in before we say goodbye. Tomorrow is Julius de Kempener and the creator of RRG. So we're going to get some great information from him. And as we were just saying, Friday, I'm going to be doing a workshop on bull and bear market rules. And that's pretty much the rest of the show. I think we've got one in the books.
Yep, it's been a great show. And again, tomorrow will be awesome with Julius coming on to join us as well and talking RRG. Bring your RRG questions with you tomorrow. And then again, Friday, as we mentioned, Erin will be going through and talking about the bull market, bear market rules and strategies and things to look for. And certainly the timing is perfect right now. I do want to thank everybody for being with us today, especially Charles Kirkpatrick. Really an informative presentation. Loved having Charles on the show. Please remember to complete the survey as you exit. We do love to get your feedback to hear what you think of Market Watchers Live. As a reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Happy Valentine's Day. See you tomorrow. Happy trading.